Even a $500,000 retirement portfolio faces substantial risks that can significantly affect long-term financial security. Inflation steadily erodes purchasing power, increasing the cost of essential items such as food, housing, insurance, and healthcare. Healthcare costs are particularly impactful for retirees, as medical spending tends to rise faster than general inflation. For example, a retiree who spends $40,000 per year may see that number increase to $52,000 over 10 years if healthcare and living costs grow faster than the official inflation rate. Interest rates remain historically low, which reduces the income generated from bonds, certificates of deposit, and other fixed income instruments. A $200,000 bond allocation yielding 2% annually produces only $4,000 in nominal income, and after adjusting for inflation, the real purchasing power of that income may be close to zero or even negative. Market volatility also presents a significant risk for mid-sized portfolios. Even modest fluctuations in equity markets can materially impact a $500,000 portfolio. A 10% decline in the value of the portfolio equates to a $50,000 loss, which may reduce the ability to sustain planned withdrawals without adjusting spending or selling additional assets. Sequence of returns risk is particularly relevant in early retirement, when withdrawals coincide with market downturns. Withdrawing from a declining portfolio reduces principal and limits the ability for future growth, creating a compounding effect that can shorten the portfolio's longevity. Taxes further erode real income. Withdrawals from tax-deferred accounts, such as traditional IRAs or 401ks, are taxed as ordinary income, while dividends and capital gains from taxable accounts are subject to federal and sometimes state taxation. For a $500,000 portfolio, taxes can consume a meaningful portion of annual withdrawals, especially when combined with Social Security income or other retirement income sources. Without careful planning, taxes can reduce net income and diminish the effectiveness of the portfolio in meeting living expenses. Longevity risk is another consideration. Many retirees underestimate how long they will live, and medical advances have increased average life expectancies. A $500,000 portfolio must support potentially 20 to 30 years of spending, which may strain the ability to cover essential costs if withdrawals are not managed strategically. Unexpected expenses, such as home repairs or long-term care, can further deplete the portfolio, highlighting the need for planning that accommodates both predictable and unforeseen costs. Low interest rates, inflation, market volatility, taxes, and longevity risk interact to create pressures that are often underestimated in retirement planning for mid-sized portfolios. Even though $500,000 may appear substantial, these factors can reduce both the real value of savings and the sustainable income that can be withdrawn annually. Without strategies to mitigate these risks, retirees may find themselves adjusting lifestyle, delaying discretionary spending, or drawing down principal faster than planned. Understanding these pressures is critical to managing a mid-sized retirement portfolio effectively. Planning must account for inflation, market fluctuations, taxation, and unexpected expenses. The combined effect of these factors on purchasing power and income highlights the importance of a structured approach to portfolio management. Even with $500,000 in savings, a retiree cannot assume that the portfolio will automatically generate sufficient income without careful attention to these real, quantifiable risks. Common retirement advice often falls short for mid-sized portfolios because it relies on simplified rules or averages that do not reflect individual circumstances, market volatility, or long-term financial risks. The 4% withdrawal rule is one of the most frequently cited guidelines, suggesting retirees can withdraw 4% of their portfolio annually without running out of money over 30 years. While this rule is based on historical market performance, it assumes average returns, stable inflation, and consistent spending patterns, which may not apply to everyone.
For a $500,000 portfolio, a 4% withdrawal equals $20,000 annually. After taxes, fees, and inflation, the real income may be closer to $12,000 to $15,000, which may not cover essential expenses for many retirees. A market downturn in the early years of retirement can further undermine this strategy, reducing principal and creating a compounding effect that accelerates depletion of the portfolio. Standard investment allocation advice, such as maintaining a 60-40 mix of stocks and bonds, also fails to account for individual risk tolerance, spending needs, and the sequence of returns risk. While this allocation historically provides a balance between growth and stability, a mid-sized portfolio can still experience significant fluctuations in value. For example, a 10% decline in the stock portion of a $500,000 portfolio can translate to a $30,000 to $35,000 drop, depending on allocation, which may force retirees to adjust spending or liquidate other assets. Generic allocation advice rarely considers the timing of withdrawals, the interaction between different types of accounts, or the impact of taxes, leaving retirees exposed to outcomes that are inconsistent with their actual income requirements. Social Security guidance also exemplifies where standard advice is insufficient. Recommendations to claim benefits at full retirement age or to delay until age 70 do not consider a retiree's overall income, portfolio size, or tax situation. For a $500,000 portfolio, claiming Social Security too early may reduce future benefits, while claiming too late may unnecessarily defer accessible income that could cover essential expenses. Moreover, the interaction of Social Security benefits with taxable withdrawals from retirement accounts can increase marginal tax rates, a factor not addressed in conventional guidance. Another area where common advice fails is the treatment of inflation. Mid-sized portfolios are often advised to maintain a significant allocation to bonds or cash equivalents for safety, yet these assets can underperform inflation over time. For example, a 2% bond yield against a 3% inflation rate results in a real loss of purchasing power, gradually eroding the ability of a $500,000 portfolio to sustain withdrawals over decades. Retirees following standard advice without accounting for inflation risk may find themselves unable to maintain their standard of living in the long term. Ultimately, conventional retirement guidance is overly simplistic for mid-sized portfolios because it assumes average outcomes and ignores critical variables such as taxes, inflation, sequence of returns risk, and individual spending patterns. Applying generic rules without adjustment can leave retirees exposed to income shortfalls and portfolio depletion, even with $500,000 in savings. A more nuanced approach is required, one that incorporates strategic withdrawals, tax-aware planning, asset allocation, and risk management to ensure sustainable income and preservation of purchasing power throughout retirement.
Generating sustainable income from a $500,000 retirement portfolio requires careful planning and strategic withdrawals rather than relying on fixed percentages or rigid rules. Even though $500,000 may seem substantial, without a structured withdrawal approach, the portfolio is vulnerable to market volatility, inflation, taxes, and unexpected expenses. Strategic withdrawals involve managing funds across taxable, tax-deferred, and tax-free accounts to maximize after-tax income, maintain cash flow, and preserve principal for long-term growth. This approach contrasts with generic guidance like the 4% rule, which does not adjust for market conditions, individual spending patterns, or account types. Tax-deferred accounts, such as traditional IRAs or 401ks, allow money to grow without taxation until it is withdrawn. Withdrawals from these accounts are taxed as ordinary income, which can push retirees into higher tax brackets if not coordinated with other sources of income. Strategic sequencing of withdrawals ensures that tax-deferred accounts are drawn in a manner that minimizes the overall tax burden over retirement.
For instance, a retiree might withdraw smaller amounts from tax-deferred accounts during the early years of retirement while relying on taxable or tax-free accounts to cover essential expenses. This allows tax-deferred funds to continue growing and reduces the likelihood of large required minimum distributions, increasing taxable income in later years. Tax-free accounts like Roth IRAs provide additional flexibility. Withdrawals from Roth accounts are not taxed and do not count toward required minimum distributions, allowing retirees to manage income more effectively in years when taxes might otherwise be high. Using Roth accounts strategically supports predictable income and protects purchasing power against inflation and rising costs. For a $500,000 portfolio, allocating a portion to tax-free accounts enables a retiree to maintain spending without triggering unnecessary taxes while preserving other accounts for long-term growth. Taxable accounts also play a critical role in strategic withdrawals. Long-term capital gains and qualified dividends are typically taxed at lower rates than ordinary income, and gains are only realized when assets are sold. By drawing from taxable accounts during lower income years, retirees can access funds efficiently without increasing their overall tax burden. Coordinating withdrawals across taxable, tax-deferred, and tax-free accounts allows a retiree to smooth cash flow, respond to market conditions, and avoid forcing sales during market downturns, which preserves the portfolio's long-term value. Strategic withdrawals also involve adapting to market performance and inflation. Sequence of returns risk is particularly relevant for mid-sized portfolios because poor market performance in the first few years of retirement can significantly reduce principal. By adjusting withdrawals in response to market conditions, retirees can maintain the longevity of their portfolio. For example, reducing withdrawals during a market downturn and resuming planned withdrawals during recovery allows the portfolio to continue compounding and reduces the risk of depletion. This system-oriented approach ensures that a $500,000 portfolio functions as a dynamic tool rather than a static balance. It provides predictable, sustainable income while preserving principal, maintaining purchasing power, and protecting against taxes, inflation, and market volatility. By managing withdrawals strategically across account types and adjusting for economic conditions, retirees can extend the life of their portfolio and maintain financial stability throughout retirement. Diversification and liquidity are critical components of managing a $500,000 retirement portfolio because they help protect income, preserve principal, and maintain purchasing power over time. Diversification reduces the impact of losses in any single investment or asset class, spreading risk across equities, fixed income instruments, cash equivalents, and other investment types. For a mid-sized portfolio, a concentrated position in stocks may offer growth potential, but exposes the retiree to significant short-term volatility. For example, a 10% drop in the equity portion of a $300,000 allocation can result in a $30,000 paper loss, which could require reducing withdrawals or selling other assets if liquidity is not sufficient. Spreading investments across multiple asset classes mitigates this risk while still allowing for long-term growth. Diversification also balances between growth and income. Stocks generally offer higher long-term returns but are more volatile, while bonds and fixed income assets provide predictable cash flow and stability. Including a mix of asset classes allows retirees to meet essential spending needs from stable income sources while leaving growth assets invested to protect against inflation and preserve purchasing power. Even within equities, further diversification across sectors, market capitalizations, and geographic regions reduces exposure to a single economic event or market downturn. This approach ensures that the portfolio does not experience disproportionate losses that could compromise sustainability. Liquidity is equally important for portfolio stability. Maintaining cash or cash equivalent holdings sufficient to cover 2 to 5 years of expenses prevents the need to sell investments during periods of market decline. For example, if a retiree requires $40,000 per year for essential expenses, holding $80,000 to $200,000 in liquid assets allows withdrawals without forcing the sale of equities or other growth-oriented investments at depressed prices. This protects the long-term growth potential of the portfolio while providing flexibility to respond to unexpected costs such as healthcare, home repairs, or emergencies. Tax diversification complements asset allocation and liquidity. Taxable accounts, tax-deferred accounts, and tax-free accounts each have unique characteristics that can influence portfolio sustainability. Taxable accounts allow for lower taxed capital gains and dividends. Tax-deferred accounts allow for growth before taxation, but require careful management of required minimum distributions. And tax-free accounts like Roth IRAs provide withdrawals without taxation. Coordinating withdrawals from these accounts in combination with diversified assets ensures steady income while minimizing taxes, preserving principal, and maintaining purchasing power over time. Regular rebalancing is essential to maintain diversification and control risk. As markets fluctuate, the portfolio's allocation can drift away from its intended balance. Rebalancing restores the target allocation, reducing exposure to overperforming asset classes and ensuring that risk remains aligned with retirement objectives. Rebalancing also provides opportunities to sell high and reinvest in undervalued areas, further supporting sustainable growth and stability. By combining diversification and liquidity with careful allocation across tax types and periodic rebalancing, a $500,000 portfolio can provide predictable income, protect principal, and maintain purchasing power over decades. These principles reduce dependence on any single market outcome, mitigate risk, and allow for flexibility in response to economic changes or unexpected expenses. Applying these strategies consistently creates a resilient system that supports retirement income needs while preserving long-term wealth and stability.
A stability-focused framework is essential for managing a $500,000 retirement portfolio because it prioritizes predictable income, long-term growth, and protection against risks that can erode wealth over time. Even mid-sized portfolios are subject to inflation, market volatility, taxes, and unexpected expenses, all of which can reduce purchasing power and threaten sustainable withdrawals. A structured approach focuses on applying principles that have worked across decades rather than relying on trends, speculation, or short-term gains. Stability means ensuring that the portfolio can consistently meet essential expenses, cover discretionary spending, and preserve capital throughout retirement. The first principle of this framework is protecting the base. A portion of the portfolio should be allocated to low volatility assets, sufficient to cover 2 to 5 years of expenses. This protects against the need to sell growth-oriented investments during market downturns, which would reduce principal and hinder compounding. Even a $500,000 portfolio can suffer meaningful losses during equity declines, so holding a stable cash or bond reserve ensures essential expenses are met without compromising long-term sustainability. Base protection provides both financial security and flexibility, allowing other portions of the portfolio to remain invested for growth. The second principle is diversification across asset classes. Spreading investments among equities, fixed income instruments, and cash equivalents balances growth potential with risk management. Equities support long-term growth and protection against inflation, while fixed income investments provide steady income and reduce volatility. Diversification within each asset class further mitigates risk, such as allocating equities across sectors and geographies, or including bonds of different maturities and credit qualities. This approach reduces the impact of losses in any single investment and helps maintain a smoother overall portfolio performance. Tax-aware management is the third key component. A mid-sized portfolio often includes taxable, tax-deferred, and tax-free accounts, each with distinct characteristics.
Strategic withdrawals across these accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. For example, drawing from taxable or tax-free accounts in early retirement while delaying withdrawals from tax-deferred accounts can minimize taxes and maximize compounding over time. Coordinating withdrawals with expected income, Social Security benefits, and required minimum distributions ensures that the portfolio functions efficiently and supports consistent income. Liquidity is another essential element of a stability-focused system. Maintaining cash or cash equivalents sufficient for 2 to 5 years of expenses prevents forced sales during market downturns, allows for unplanned expenses, and provides flexibility for adjusting withdrawal strategies. Liquidity supports both financial stability and peace of mind, ensuring that the portfolio can continue generating predictable income even under adverse conditions. Finally, regular review and rebalancing preserve the integrity of the framework. Market fluctuations, changing interest rates, inflation, and evolving personal circumstances can shift the portfolio's risk profile over time. Periodic reassessment ensures alignment with long-term goals, maintains diversification, and adjusts withdrawals to reflect economic conditions and spending needs. A stability-focused system applied consistently transforms a $500,000 portfolio into a dynamic tool that supports predictable, sustainable income while preserving capital and purchasing power, even in the face of uncertainty. Money in retirement today is facing pressures that affect both small and mid-sized portfolios. Inflation continues to push the cost of living higher, with essentials like healthcare, housing, and groceries rising faster than many retirees' nominal income. Interest rates remain low compared with historical averages, reducing the yield from bonds, savings accounts, and other fixed income investments. Purchasing power is declining as inflation outpaces traditional income sources. Government debt remains high, influencing fiscal policy and future taxation. Currency devaluation gradually erodes cash savings, and retirees face the risk of outliving their assets while managing unpredictable expenses. A $500,000 portfolio, while substantial for many, is not immune to these factors and requires careful management to generate sustainable income. The problem is that a mid-sized retirement portfolio must support decades of spending while navigating market fluctuations, inflation, taxes, and healthcare costs. For example, a $500,000 portfolio generating 5% annual nominal returns produces $25,000 per year. After inflation at 3%, fees, and taxes, the real income may be closer to $15,000 to $18,000. This amount may not fully cover essential expenses without careful planning, especially in early retirement years when unexpected costs arise. Even a small market correction can reduce principal substantially. A 10% decline, which is common in equity markets, would reduce a $500,000 portfolio by $50,000, requiring careful adjustment to withdrawals to maintain sustainability. Common advice fails for mid-sized portfolios because it assumes averages or rules of thumb that do not match individual circumstances. The 4% withdrawal rule, generic stock-bond allocations, or standard Social Security timing do not account for variability in market returns, taxes, or inflation. A fixed withdrawal percentage can quickly deplete a $500,000 portfolio if markets underperform early in retirement or if inflation exceeds assumptions. Standard investment allocations may expose retirees to more risk than their income and spending needs allow. Generic guidance rarely addresses tax efficiency, sequence of returns risk, or portfolio flexibility, leaving mid-sized portfolios vulnerable to both depletion and reduced purchasing power. What works is a structured, principle-based system designed for stability and sustainability. Strategic withdrawals across taxable, tax-deferred, and tax-free accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. Diversified allocation across equities, fixed income, and cash equivalents balances growth potential with stability. Maintaining a liquidity buffer of 2 to 5 years of expenses reduces the need to sell investments during downturns, allows for unplanned expenses, and provides flexibility for adjusting withdrawal strategies. Periodic rebalancing ensures the portfolio remains aligned with risk tolerance, income requirements, and long-term objectives. What works is a structured, principle-based system designed for stability and sustainability. Strategic withdrawals across taxable, tax-deferred, and tax-free accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. Diversified allocation across equities, fixed income, and cash equivalents balances growth potential with stability. Maintaining a liquidity buffer of 2 to 5 years of expenses reduces the need to sell investments during downturns, allows for unplanned expenses, and provides flexibility for adjusting withdrawal strategies. Periodic rebalancing ensures the portfolio remains aligned with risk tolerance, income requirements, and long-term objectives. What works is a structured, principle-based system designed for stability and sustainability. Strategic withdrawals across taxable, tax-deferred, and tax-free accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. Diversified allocation across equities, fixed income, and cash equivalents balances growth potential with stability. Maintaining a liquidity buffer of 2 to 5 years of expenses reduces the need to sell investments during downturns, allows for unplanned expenses, and provides flexibility for adjusting withdrawal strategies. Periodic rebalancing ensures the portfolio remains aligned with risk tolerance, income requirements, and long-term objectives. What works is a structured, principle-based system designed for stability and sustainability. Strategic withdrawals across taxable, tax-deferred, and tax-free accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. Diversified allocation across equities, fixed income, and cash equivalents balances growth potential with stability. Maintaining a liquidity buffer of 2 to 5 years of expenses reduces the need to sell investments during downturns, allows for unplanned expenses, and provides flexibility for adjusting withdrawal strategies. Periodic rebalancing ensures the portfolio remains aligned with risk tolerance, income requirements, and long-term objectives. What works is a structured, principle-based system designed for stability and sustainability. Strategic withdrawals across taxable, tax-deferred, and tax-free accounts allow retirees to minimize taxes, maintain cash flow, and preserve principal. Diversified allocation across equities, fixed income, and cash equivalents balances growth potential with stability. Maintaining a liquidity buffer